Hello everyone, welcome back to RR Corporates. Now we are discussing on GST compliance for fertilizer and pesticide dealers, particularly on Rule 37 stock returns and interest tax. Today's topic is extremely relevant for traders in the fertilizer and pesticide sector, especially those dealing with farmers. This is unique, it's a business structure heavily credit driven and highly seasonal and often operating in rural areas with a minimal GST literacy. So in this video, we will decode Rule 37 and ITC reversal on delayed payments, GST on return goods, credit note versus invoice, and taxability of the interest recovered from the farmers. This is what we are going to discuss. And practical steps to stay compliant. Let's start with the basics. We'll see the sector overview. Fertilizer and pesticide dealers operate in specialized supply chain. And there are some unique traits. One is end user are only the farmers. Farmers are the end users. So the entire market is B2B, yet farmers are not registered GST entities. And business is a seasonal. Demand spikes during sowing periods and particularly in sowing periods, demand spikes and it drops significantly off season. Sales and credit. So retailers extend credit to the farmers. Wholesalers follow credit to the retailers. And this cycle continues up to the manufacturer. So completely on sales and credit. And frequent stock returns will be there due to demand fluctuation. So unsold goods are returned regularly. So low GST awareness at lower levels, that is another thing, especially in rural or small town businesses. The understanding of GST is still evolving. These operational realities give rise to three core issues, GST challenges. Rule 37, if you see, it talks on ITC reversal on delayed payment. Rule 37 of the CGST rules. If buyer does not pay the invoice amount, including GST, within 180 days from the invoice date, the ITC claimed must be reversed and interest at 18% per annum is payable. I'll give you an example. Invoice date is 1st January 2024. So the amount 1 lakh plus tax, that is 18% GST. So payment due date 29th and 30th June 2024, because we are saying 180 days. If the payment is not made by them, the dealer must reverse that ITC input tax credit, that is 18,000, 18%. Then the pay interest from 1st January to the date of reversal because of these 180 days. The partial payment, suppose the portion is paid, ITC reversed proportionally, and interest applies only to the unpaid part. Maintain monthly reports of outstanding payment versus ITC claim, that would be the better. So to avoid these issues, and maintain monthly reports of outstanding payment versus ITC claim. That will give clear clarity. So stock returns. We'll talk about the stock returns because credit note versus tax invoice. This issue is very common in small towns and among rural retailers. The problem is retailers often issue a debit note to return stock, but this is not valid under GST law. Correct legal process is Section 34 of CGST Act. The supplier, wholesaler or manufacturer must issue a credit note. Conditions: the buyer must reverse the ITC on the returned stock. The credit note should be reported by 30th November of the next financial year. There is another alternative option is the supplier. If the supplier does not issue a credit note, the buyer, that is a retailer, may ask issue a tax invoice, treating the return as outward supply. So they must charge GST pay tax and show in GST-R1, the supplier can claim ITC on this fresh invoice. Same logic applies to returns up the chain from wholesaler back to manufacturers. Practical advice: suppliers should avoid letting retailers issue debit notes. It breaks the compliance chain. And third one, GST on interest collected for late payments. Section 15, subsection 2D of CGST says if a dealer charges interest, penalty, or late fee due to delayed payments, it must be added to the taxable value of the original supply. So the original sale at 5% GST, interest for late payment 2,000, GST at the rate of 5%, that is 100 rupee. The total tax liability increases because of this GST. This applies irrespective of whether you are a retailer, wholesaler, or manufacturer. So do not forget to charge GST at the delayed payment interest. It is a common oversight that leads to audits and demand later. So the practical compliance tips are: first, keep dealer payment timelines. So maintain a track for 180-day ITC reversals. And second one, educate small retailers on the need for proper credit note process. Third one, avoid buyer debit notes. So suppliers should always issue credit notes as per the law. Fourth one, review GST-R2B versus books on monthly basis. So especially for unmatched ITC. And fifth one, tax interest on overdue amounts. So include it in invoice, so in GST-R1. And train rural staff and retailers. The compliance gap usually begins from there only. So the conclusion is Rule 37, ITC reversal can quietly erode profits if not tracked properly. Then improper handling of returns can disrupt GST chains and lead to notices. Interest on delayed payments must be taxed correctly. If you found this video useful, don't forget to like, share, and subscribe. Hit the bell icon so that you will not miss any of the latest videos. Two channels we have: RR Corporates and RR Legal Talks. Thank you.